great future. We're talking real money.
Yes, he is, ladies and gentlemen. Tom Cock, look, he's back in the Museum of Modern Model Military Aircraft. Modern and medieval military aircraft. I'm trying to come up with as many M's as I possibly can to be as elucidative as possible.
To be completely honest, you can say middling. You could put that in there because I'm the guy who made them.
Military model, messy, make-do aircraft. Massive airborne.
Middling.
Anyway, that's enough of that stupidity. Don't you love the... Yeah, okay. But do you... this is not a video podcast, so...
okay.
Do you love the video podcast logo from the model military? Did you ever see the logo?
I never saw the logo.
You don't even watch our videos.
I do. I tell you what I did watch. Last week's video that you did, that's the best one we've ever done. You did it by yourself. It was phenomenal. I urge everyone to go see that one.
That was
about the charges.
Morgan Stanley.
Really good.
Here's the thing. Morgan Stanley in their own words.
Yeah, and most people have no idea because they get this portfolio. They think their portfolio is somehow unique because they're working with Morgan. It's basically individual stocks. It's a few actively managed funds and maybe a few index funds so they can say, oh, yeah, we have you in index funds. And then oftentimes individual bonds of some kind.
I didn't see any index funds in the list I looked at.
No. And people have no idea what the cost of all that is. They have no idea how little diverse. Anyway, I don't remember the title of that one.
I don't know, but it's the last one.
It's really good. And
it's the one
to be commended.
From the
last like
week.
the 18th
Thursday.
or something.
Yeah, Thursday.
Anyway. Good. Go watch it.
Yeah, go watch it. It was fun to do. Mm-hmm. Today, it's kind of funny that we're doing this because it almost sounds like a repeat of what I did on Saturday when Tom was boating on lovely Lake Chelan.
We found your phone, by the way. It took some work.
We found my phone before, and then it was ruined because it went too deep. Now you made me lose my train of thought, and that is not hard to do these days.
These days,
it's really, really easy.
Walk into a room and go, wait,
what?
Okay.
Why did I come into this room?
Here for a reason.
Over the weekend, I talked about a Jason Zweig article from Wall Street Journal. It was about mutual funds and how they are allowed. They were allowed to pick their own benchmarks against. To compare themselves against.
But just go describe first when you say benchmark.
Well,
what does that mean? What is a benchmark?
There are now thousands of benchmarky categories.
Yeah, it's
like they compared themselves to a category that had more small caps. I think they compared themselves to some sort of a dividend small mid cap category.
But a benchmark in general is a line.
Is an index, or it's
a line where. Right, you're going to do better, you're going to do worse.
But I just found it fascinating that the mutual fund companies can kind of change the rules of the game to suit their purposes. And it's funny because, with my brother's funeral, we got together, and my sister, of course, has this incredible memory. I hate her for that. And she's spouting off about how, Donnie, when you were little, you used to cheat at Monopoly. And that's not her voice, but... and I guess I did. I don't remember doing that.
Yeah, but you were the banker, and I was the
banker, and she told me that I told them that the banker gets to make the rules.
That sounds a lot like you, I have to say, at any age.
And it's it's kind of like America. The bankers make the rules, don't they?
They do. I just paid some of them their rules just a few minutes ago to buy gasoline, which I just find astounding. But
hold on. You had to take out a mortgage to buy gasoline?
Well, a third in this case, but I managed to get enough to drive home barely. So it's not easy. But they make the rules. But the reason this all came up is, as you said, the mutual funds. But then to take it one step further, this was in Bloomberg last week. Some fascinating reading. In the Journal of Portfolio Management, which Bloomberg quotes. The author says public officials who manage $4 trillion, by the way, $4 trillion, that's a lot of money for 26 million working and retired teachers, cops, and other public employees. Here's the key part. Routinely set their benchmarks too low and in many cases receive bonuses for their accomplishments. In other words, okay, I'll do.
Oh, so
I'll
we're
do
talking
5
actually
push-ups.
2 different kinds of benchmarks.
Yeah, exactly.
A benchmark is like a comparison against another.
That's what I was asking.
Yeah.
That's why I wanted.
In
to get
this
to that.
case, a benchmark is the goal
Yep.
that these people have set for themselves. So that would be like me saying, "Hey, I'm in a sales job. I tell you, let's start my goal at 0 sales, and anything I get above that, I get a big bonus for."
Exactly.
Does that work for you?
It works for me. I'm hoping do me for like 10 push-ups, and I'll beat that.
No, I'll beat 0. I will beat 0.
The fascinating part is it's hard to imagine that they get to set that on their own. It's hard to believe that then all these consultants who are involved are in the process say, "Oh, great job. You really did that." And of course, most of these people that sit on the boards, they have no idea. It's all been run by the people that run the pensions. And the quote from a Securities and Exchange Commission attorney who's audited dozens of pension funds says, "No pension is going to keep a benchmark that makes it look bad." Really? That's not much of a surprise there.
So wait. So I remember when they used to be accused of setting their sights way too high, that they made
they used to say
they made actuarial assumptions based on very high returns, double-digit returns, which they weren't able to meet, and therefore all these pensions went broke. So now they're saying, well, instead of saying high, we're just going to go really, really low, and you got to pay us more if we do just average.
And this particular podcast is not about that. Okay.
Oh, just thank God, because that would have been really short and boring.
Yeah, and because that's a topic, and many people have written about it, that the honest truth is they underperform just index funds in a general sense. This podcast is designed to talk about you and what rate of return or what benchmark you should have, you, an investor, because this is not easy, right? In other words, this is like, well, if I could make 8% a year, will I be okay? Should I have a benchmark of 8% a year? How do you evaluate your returns? How do you make those sort of decisions about, well, I've done this for 10 years and it hasn't worked. Maybe I should try something else. When I read the article, I thought this is something that comes up from time to time because people say, well, you're diversified. You owned XYZ for the last 5 years. That didn't make any money. Let's get rid of XYZ and move it into this other fund that made a lot of money. And you say, no, you've got to let this play out for a long period of time. So the question to you, Don, is should people have, as investors, a benchmark, a line in the sand that says, I should do better than this, for example?
Well, you have to set a level of expectation, because you have to plan off of a level of expectation. You can't plan for retirement unless you have some idea what you can have, possibly what you can and have in the past expected. The problem is relying too much on that and also judging that over too short a period of time. The biggest problem is judging the asset classes in your portfolio individually. Individually, some are going to do well better than what you expected, and others far worse at any given time. What you need to look at is the overall performance of a portfolio over your pre-established time frame, which is part of your plan.
You're saying, okay, so I'm 64. I have like a 30-year, which is probably outrageously too long because I probably don't have 30 years. But when I look at my plan, I say, the money's got to last 30 years. So what do I need to make on that money to have over
the 30-year time frame? Correct. And you really should not judge an entire portfolio over anything less than half a decade. And I'm talking about an entire portfolio. You see, the problem is people look at asset classes. They go, my bonds didn't do well over the last 5 years or whatever it was. But some other things in your portfolio probably beat those. And the other thing you need to be aware of is getting too caught up in the current situation, the immediate situation, the right now. We put way too much importance on the right now when it is, what is the outlook for the planet economically?
Yeah, I think recency
is it going to
bias.
collapse? Yeah, it's a recency bias thing.
Yeah, I think that's true. Okay, but let me ask you another question along these lines. Is it fair over, I don't know, 10 or 15 or 20 years to compare your portfolio, your investor portfolio, to VT, for example? Would it be fair to put that up and say, I should be doing about this or better?
If your portfolio is 100% equities, it can be a guide, but it can't be absolute unless your portfolio is almost identical to the entire world stock market portfolio. It's not, for example, if you build a portfolio the way we suggest building a portfolio, which is more complicated than most people want to dive into, and that is increasing your small cap positions and increasing your value, having money in emerging markets, doing some of the more eclectic things that have over time added return, but for a very simple reason, because they add risk. See, there's no magic. If you want to add return, you have to add risk. And that, when you start comparing those kinds of assets to VT or that kind of a portfolio to VT, it's not a fair comparison because it's going to be more aggressive inherently than VT, just owning the big caps, basically.
Well, okay, but let me give you another example. So over the last 52 years, the 100% stock portfolio, according to the Merriman Foundation global portfolio, has made a little over 12% a year. Is it fair to say, hey, I should make 12% a year for the next 20 years if I'm in that portfolio?
No, you could probably say, maybe I'll make that over 50 years if I hang in there with it, but I cannot possibly expect that because the next 50 years may not look anything like the last 50 years.
Thank you. That's what I was getting to. Yeah.
The reality is that equities, what you have to do is look at the broader market, not the specific numbers. Over time, stocks have and should outperform bonds or other safer investments. That's it. That's what you should concentrate on. Is it likely, if I'm invested heavily in stocks, that I'm going to, over time, over the next 20 years, make more money? Yeah. Will it be 12? Who knows?
That's what I was getting at. Looking at the 52 years, you put the odds in your favor for the next 25 or 30 years by having the right balance for you, because you need to know what balance that is between stocks and bonds, being massively diversified and keeping your costs low. Other than that, I think benchmarking is unfair because I think it's just, there's too many variables there for the next 10, 20, 30, 40, 50 years to say, yeah, I should make as much as that portfolio made in the last 52 years. The next 50 undoubtedly will look different than the last. I don't know how, but I do know you put the odds in your favor by doing the aforementioned things.
Yeah. Anybody who tells you can make a 12% return on your money in the future is lying, Dave Ramsey. I'm sorry. Did I say 14? Dave Ramsey in that sentence?
I think he's at like 14. Don't cut him down to 12.
He's always said, it's going to make 12 in the future because it's made 12 in the past.
Oh, yeah. Sure.
And he goes, these financial advisors tell me you're not going to make 12% in the future. Well, listen to me. I've made 12% per year. Dave, did you notice the operative word in that sentence? I have made 12% per year. I have.
Tense. Yeah.
You didn't do because you don't know what you're going to do. You only know what you did do. Do.
Can't plan on that. I mean, and the only thing you can plan on is uncertainty. And that's why when we do the planning portion of all this, we look at 1,000 potential outcomes in a Monte Carlo, because that's the only way you can really say,
we need a better name. We need a better name.
I hate that name.
I hate that name because it's kind of like, here's what works if you go to Monte Carlo.
Yeah,
well, like James Bond, I'll play Baccarat. I'll choose Baccarat, please.
You ready for a question?
Oh, we're flipping the table,
That's what I said. This is exciting for me.
Tom is question boy today.
They sent this to me. I don't know why I'm on the.
I don't get it anymore.
I know. That's what I'm saying. I don't know why. One question was from, I won't even say his name, wants to meet with me on Saturday. I think that's already set up. But he did say
another one who's getting to meet with you.
He did say that he watched your brother's memorial service, called it moving, and sent condolences to you and your family. So,
Very
which
sweet.
I thought was very
Thank you.
kind. Roger wrote us. Roger from Phoenixville, Pennsylvania, which I'm not familiar with, but
That's just north of Phoenix, Arizona.
considerably cooler
and
at this
east.
moment, I hope. But he wrote, and I'm not going to go into all of it, talked about how much in retirement accounts, quite a bit. Terrific. But here's the question. He said, we plan to take Social Security at age 70. And at current calculations, that'll be $96,000 a year. I'm assuming that's two.
That's got to be
lot.
two
Yeah.
people. No, the max is like 50,000.
Yeah, no, I mean, that's good. Would you recommend we build this into our portfolio makeup? In other words, if we start to take Social Security at 70, should we assume Social Security is part of our fixed income? Because it is fixed income.
But it's not an asset.
Let me finish.
Oh, okay,
the philosophy will allow us to be more aggressive, but negates. In other words, you're putting more in stocks because you're assuming that the Social Security part is part of your bond portfolio.
Okay, I get the thinking. I get it. I understand it.
Yeah.
And being more aggressive, I think, is a groovy kind of thing. Groovy. Excuse me. But it's not the asset class. And the reason we suggest you have fixed income for part of your portfolio has nothing to do with the income stream. Nothing whatsoever to do with the income stream. It totally has to do with your stomach, with your gut, with your ability to sit tight when things look bad. That's why fixed income exists. So for that, Social Security isn't going to stop at your portfolio. Let's say your portfolio is 100% stocks and we get a 2008 market and it goes down 50%. How are you going to feel? You see, if you had a balance in that portfolio in 2008, you would have only lost about 25%, depending on the kind of balance you had. It would have made the decline more palatable, less frightening. And that's why we suggest fixed income. For that reason, and really that reason only.
Well, that not only, but because when you're doing the withdrawals, if you have a stable base of money in bonds, you can pull from that instead of pulling from the stocks. But the other way, I'd put that percentage into actual numbers, because they have $3 million in retirement accounts in 2008. That would have gone, if all in stocks, that would have gone down to somewhere around $1.5 million. Which for many people you'd be pretty scared. And be like,
it would be devastating. It would be emotionally devastating.
Yeah, it would be.
And that's the reason. It's emotions.
Yeah. And here's the other part of that. Do you need to? We've talked about this many times. Do you need to drive 75 miles an hour? Do you need to take risks? Now, I'm going to argue probably not. So why you take a risk that you don't have to take? So no, I don't think Social Security should be considered bond-like in any fashion, and I would not look at it that way when I was making my risk-return trade-offs.
Yeah, and when you get to retirement, when you get to collecting Social Security, the race is pretty much over. You got to stop striving for more and and more money. You're nearing the finish line. You might as well just enjoy the spoils of your future or your past wins, and
it's a good way to put it.
Like golfers or race car drive, they all just kind of eventually go, I'm not going to keep racing to make more money. I'm just going to enjoy
I'll
what
open a bad restaurant and watch it go out of business. Before we say goodbye, I want to say congratulations to you, because you're the primary driver of this program. I'm on it. I'm glad to be here. But you're the guy who does the editing. You do all the heavy lifting. And we just received a news release a couple of days ago that we have passed 3 million downloads of the podcast Talking Real. That's a big deal.
No,
I know you're
poo-pooing
it. Okay, it's not a big deal.
Let me tell you why
it sounds like a big deal to me.
Because it's only 3 million since we moved from one hosting company to another hosting company. So there's probably another 500,000 or so from that other hosting company.
Well,
so it could be 4. I don't know how many it is.
It's a lot. So
it's more than 3 million, though.
I still, by the way, to this day, don't know what a download is, but whatever it is,
it is someone listening to the podcast for more than 60 seconds, according to the Internet Advertising Bureau.
I thought it was something that somebody told you that you weren't supposed to expose to others down low, but I don't know.
That's on the down low.
Oh, okay. All these years I've been confusing that. So dang it. Okay.
You confuse a lot of things.
There is that aspect. Thank you, partner, for great work there. And congratulations. And thank all of you for listening to us, which we do appreciate.
Yeah, we do that. Yeah, we appreciate you. And check us out on your favorite podcast service. If you just started listening, you can subscribe on Apple Podcasts, Spotify, tell your friends, share it on social media. We're trying to get our Spotify numbers up. Come on, help us out here. It's so funny. We have like half of our downloads, more than half of our downloads come from Apple Podcasts, and only about 5% come from Spotify, which is way up from the 3% of a few months ago.
That's almost a double.
Yeah, but it's very strange because Lit Reading, my short story podcast, about 55% of my downloads come from Spotify.
Go figure.
I don't know why.
We'll fix that. Don't you worry, my friend.
We are. As a matter of fact, we are, because we're now hosted by Spotify. So we don't know how many downloads we're going to have from here because we just started over. As a matter of fact, I just started a few days ago with Spotify, and we're at like, get this, you're going to love this number. We've only been on the Spotify platform for about 4 days. We're at 50,000 downloads.
Wow. Good. And since they're the host, are they paying the mortgage and the light bill? Actually, the air conditioning bill.
No, they kind of rent all that. They're the host, but we're the renters.
I see the check is still being written by yours truly.
Yeah,
Got
we're
it.
still writing the check.
All right, good.
All right.
Anyway.
So that's that. You have anything else you would like to add that
we'll
you
get
think
to a
is
couple
important?
other things in the next one or two. So I got plenty of stuff, but we'll do that.
Okay.
We'll leave it at that.
We'll finish this one.
Yep.
We'll bid you farewell. We'll tell you if you want to call us with questions, you can do so at 800-386-855. That's how you call Tom, 800-386-3004.
Anytime, day or
That's how
night.
you call Tom.
Yeah, all right.
If you want to call the show, it's 855-935-TALK, or you can send questions in at talkingrealmoney.com, where we also have the risk quiz and lots of other cool stuff. Thanks so much for listening. We really do appreciate you being there. That's Tom Cock. I'm Don McDonald, and we're going to go cogitate before talking real money.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Are we done now?